Welcome back to the Mortgage Guru podcast, everybody. We're taking a slightly different approach here, perhaps a new format that I'm going to stick to. In that normally it's just a straight audio recording, a static background. If you ever watched it on YouTube, well, now I'm doing it in person. And if you want to see my smiling face while listening to this, and you're usually taking this in on a podcast app, head on over to YouTube, and there I'll be talking you through this episode. So let's jump right in. You know, one of the most important things that we had our eyes on this week was inflation data, and really has been the most important thing for the bond market, at least the last 12 months. And I reiterate this, I feel like every single episode, and there's nothing wrong with that because it's so critical to understand. And even when people hear it once, they forget it. And even those people who've known me for a really long time, and I beat on this drum all the time, still need constant reminders, especially in the environment that we're in, where there's so much emphasis on what the Fed is doing. But the thing that actually drives mortgage rates is not the Federal Reserve and their overnight lending rate, which is what they're manipulating when they change rates. But what drives mortgage rates is the bond market, specifically mortgage-backed securities and the bonds associated with those securities. Now, mortgage bonds track very closely U.S. government bonds, specifically the 10-year Treasury. They kind of have a very close trend to each other. Now, last year, partly because of all the things that were going on from a risk standpoint and just bonds being extremely volatile, no matter what sector of the bond market you looked at, the spreads between U.S. Treasuries and mortgage bonds were the widest in history at points. So they still were tracking each other, but things were getting a little messy and ugly. But we're starting to see those spreads tighten a little bit, which is a good sign. But the point I'm making here is that the inflation data, which anytime there's high inflation, and certainly the last 12 months, you know, you're talking 40-year highs in inflation. The June, July CPI prints, you know, were upwards of 9%. Those are some really scary numbers just in general. But when you're a bond investor, that's enough to make you, want to throw everything out the window as far as your bond investments. And that's what investors were doing in the bond market. And that's what actually drove interest rates, specifically mortgages, to multi-decade highs, because as people sell, the price goes down, right? Law of supply and demand. There's less demand for those bonds. There's more people selling. The price is going to decline. Well, interest rates have an inverse relationship with the price. So as people are selling the bond, the price of the bond goes down and interest rates go up. And because that was happening pretty much consecutively and consistently without much of a breather all of last year, that's how we saw this massive acceleration in mortgage rates in such a short period of time. I mean, we were already seeing big moves in mortgage bonds and mortgage rates well before the Federal Reserve had even raised their benchmark overnight lending rate, the Fed funds rate, just one time. So is there a relationship there? Yes, but the overnight lending rate that the Fed manipulates or lowers and raises, whenever you hear the Fed is wink, wink, quote, quote, raising rates, it's an overnight lending rate, and it has it's a more indirect relationship to bonds, whereas things like credit cards, personal loans, even things related to the mortgage market like HELOCs, those things are more closely tied to short-term lending rates. And so when the Fed is raising the Fed funds rate, that has a more direct impact. And it's a double whammy when you consider what was going on with inflation data, the reaction from the bond market, and then the Fed raising as aggressively as they have. So this week, and we talked about it last week, all eyes were going to be on the CPI inflation data, Consumer Price Index. That came out this week and generally was right on the nose with expectations. It doesn't mean that the data isn't something we should be peeling apart here, because inflation did come down a bit from November. November's year-over-year print, which is how inflation is measured specifically in the CPI, is a rate of change. So in November, it was 7.1. The December number came in at 6.5. That's headline CPI, which excludes food and energy. The reason they exclude that is they're considered, those components, food and energy, are considered volatile. But, the irony there, right? Two of the most expensive things that we all have to pay for, and they don't even count that in the inflation data. So, when we were getting June and July prints of 9%, I think all of us were feeling more like 15% or higher inflation. But when you exclude food and energy, that's what you get. So the actual month over month number was negative. It was negative 0.1. And as far as expectations were concerned, expectations came in obviously a little bit higher than that. So overall, it was a great tailwind for the bond market. And we saw a bit of a rally, but most of the momentum had already kind of been baked in last week when we had the ISM services index miss expectations by the most ever outside of a recession or financial crisis. So either we're on the precipice of one of those, recession or a financial crisis, or we just had a massive data anomaly. And so all of this is a matter of speculation and probabilities, but the probabilities do seem that all is not well in the US economy. And that brings us back to the CPI data, because one of the frustrating things about CPI, specifically this most recent report, is the only reason it even came in as hot as it did was because of the shelter component. Now, everyone might sit there and say, yeah, well, of course, look what real estate prices are, et cetera, et cetera. But that really is old news. And ironically, that's what CPI often is old news, especially in the housing or the shelter component. So CPI is a lagging index. It's notoriously on a lag. And this is one of the criticisms that both CPI and the Fed get, because the Fed using the CPI to conduct monetary policy feels like them driving the economy while looking in the rearview mirror. So that shelter component, being that CPI is typically on a lag and the data they use is therefore on a lag. When we look at other data sets that are more real-time or better forward-looking indicators, we see whether it's house prices, which have been on a 4-month decline, or the rent data, which is showing new leases more or less falling off of a cliff. So when we look at that, we consider, okay, the only thing that was kind of keeping inflation, we'll call it lukewarm this month or this year-over-year number, was the shelter component. We can see that the shelter component is not actually anywhere near what was reporting in the CPI. It seems like inflation is in the rearview mirror. And I was saying this last summer that, we had seen peak inflation in June or July. One of the reasons is the base effects. When they are calculating year over year, currently it's based on the previous 2 years that they're using the base effect to get that rate of change. They're making an adjustment to that in February. It's only going to be looking back 1 year, which is going to, I feel like, accelerate the deflationary fears in the economy, because if come February, we're only looking at 1 month or one year over year, Well, last year, 2022, we're having record high inflation, 40-year high inflation. So the likelihood that going forward, only comparing this year's data, 2023, to just 2022's data in terms of rate of change, you're going to hear the narrative of, the Fed has slayed inflation, which is what I called last week's episode. And whether you believe that or not, from a rate of change standpoint and from a market narrative standpoint, we want that in the bond market. We want that in the mortgage rate world. And certainly for housing, if we want housing to kind of find its footing here at some point, we need interest rates to get back to a point that people feel secure and or motivated and more or less that, they simply can qualify based on the cost of homes and what the mortgage payment's going to be. We need some positivity as far as these narratives, even if it means a little bit of uncertainty around the economy. Unfortunately, that's generally what drives mortgage rates lower. I've kind of always had mixed feelings about, what I do in the sense of providing various consultation and forecasting for people on how they should structure their mortgage and what they should do. We're always looking 6 to 12 months ahead. And we're always trying to spot those weak points in potential deflationary environments, because that's when the bond market rallies. Investors will move their money out of riskier assets like the stock market and into what we call risk off assets like bonds. And the reason that they're a risk off asset is because a bond provides an income stream. And when things are uncertain, you're not interested in speculating. You just want to protect your principal and get paid while you're doing that. So bonds tend to rally in hard times. And so as much as I'm bringing a positive message about mortgage rates, it's coming off of the back of the likelihood that we're going to head into a recession. It could be a nasty one. And a lot of the data that would give us a sense of where the economy is going is decelerating very, very quickly. So there's plenty to be concerned about. But right now, for the here and now, the inflation data is cooling. It's enough to give bond investors a little bit of confidence to come back in and gobble up some bonds. Now, they're doing it somewhat enthusiastically, but I would not say aggressively. And I hope to see them come back into the market aggressively soon here and really bring us a strong bond rally. But what we have seen over the past couple months, the 10-year Treasury at one point was dancing around 4.25%. And at the end of this week, it closed back under a very important support level at 3.5%. I won't get too much into the technical analysis side of things, but investors love to draw various lines on charts, and there's certain patterns that they look for. And at various lines on that chart, they'll pick things or spots that they consider to be support or resistance, more or less the idea that the price that they're looking at is either struggling to break through or break below that number. In the case of bonds and mortgage rates, the way we're looking at things, lower rates are better for us. So for a while, the bond market prices, and therefore the rates associated with those bonds, the 10-year US Treasury specifically that I'm discussing, was unable to push back below 3.5%. So that line in the sand was acting as a resistance. Well, closing out the week just below it could have, flipped the script on that. And now maybe 3.5% can provide support for us, where it's now the market doesn't want to go above that again. They're comfortable staying here. Money, cash on the sidelines, and asset allocators are now becoming a little more confident about the inflation scenarios, and therefore reallocating capital into the bond market. So I think you're going to see a big shift here. How quickly this happens is going to depend on the data and how the economy continues to roll forward the next couple months. But I think 2023 is going to be a great one for the bond market. It's going to be, therefore, a great one for mortgage rates. The thing, what the jury currently is out on, and we're all trying to decide, is, are interest rates on mortgages going to decline fast enough to support home prices or the housing market in general? Now, I believe most people are in a good spot. They either have extremely low interest rates from a year and a half ago, or in a combination with that, lower interest rate that they have, they also have a ton of equity. So the other thing that comes along with somewhat of a slow housing market, recession, also happens all the time when the Fed goes through these various types of rate hiking cycles, is we start to see a spike in unemployment. And so it doesn't really matter how good your rate is, how low your payment is, or how much equity you have. If you can't pay your mortgage because you aren't working, none of those perks or qualities about your mortgage matter anymore. So there's all these little moving pieces that we're watching very, very carefully. And as the dominoes start to fall right now, the main domino is inflation is starting to fall over. That's a good thing. But why is it falling over? Well, there's a lot of weakness in the economy. And the only thing that's really holding up the numbers at this point, making things look still potentially overheated, is the shelter component. But the shelter component in CPI is backward looking. And when we look at other data, it shows that shelter component has completely fallen apart. So if things accelerate in the next couple months, certainly it's going to make interest rates go lower as more and more money goes into the bond market for that risk off safe haven trade. But what will that mean for housing and employment? Those are the next two pieces everyone is watching right now. So hopefully you found this helpful. I'm going to revisit a lot of these ideas each week because they're generally the most important themes that we're monitoring every week. And there's always some kind of data set or something happening during the week that shines a spotlight on, some of these concepts, because it's this risk off, risk on, inflation, hot, inflation cool. All of these things drive investor sentiment, specifically in the bond market, which ultimately drive mortgage rates. And the other thing we're starting to see as an indicator of what market sentiment is, specifically as far as risk off or risk on, is the yield curve is deeply inverted. And I don't want to get too caught up in that right now. This will leave me a little bit for us to talk about next week, in case it's somewhat of a slow news week. But yield curves are a great forecaster. They always have been, of some form of economic trouble, recession, again, crisis, but they have always done a good job, almost with 100% track record of predicting recessions within 8 to 12 months of inversion. There's inversions basically across the entire curve. And like I said, I won't get too much in the weeds on this, but I do talk about yield curves all the time. So it's probably a term you're somewhat familiar with. But when longer term bonds have a lower interest rate than shorter term bonds, it means investors are lacking confidence in where the economy is headed. And given how deeply inverted and for how long all of these various yield curves have been inverted, the market and its participants, investors of all kinds, are screaming with their money that they're not confident in where the economy is going, and they do feel that the Fed is going to make a policy error. And one last thing I will say about the Fed, they are now, as of last week or the other week, they are in the 4.25 to 4.5 range on their overnight lending rate, the Fed funds rate. And, the sentiment is that maybe they raise one or two more times, and maybe those hikes are much, much smaller. So perhaps in the 0.25% range, but the terminal rate, which is the term used for where the market thinks the Fed is ultimately going to stop, is very, very close at this point. The way investors are positioning, for example, on the Fed funds futures market, it doesn't seem like the Fed is going to get much higher. And it does seem like the terminal rate that the market is predicting is less than 5%. So at this point, does it matter as much? The Fed has risen very fast and very far, 425 basis points in roughly 8 months. I think that takes time to work itself through the economy, and we're just starting to see that the effects of that rate hiking and that monetary policy adjustment. So the Fed at this point is wise to kind of take a pause, but a pause does not mean a pivot. And you'll hear that term often, where the next thing is predicting where the terminal rate is, and then at what point does the Fed pivot and start to cut rates. And yield curve inversions are giving us a signal of that. The way people are positioning themselves in the Fed funds futures markets, but all of these data sets, history is on our side, yield curve inversions are on our side. It does feel like a recession or a rapidly slowing economy is in our future the next 2 quarters. At least Q2, I think we're going to start to see things slide apart a little quicker. And again, I hate to say it, but it's what we're looking for as far as mortgage rates are concerned. But how bad does it get? Or, what's the benefit of having really, really, really low mortgage rates if people are losing their jobs, housing prices are sliding quickly, and the economy is falling into a deep recession? In a Goldilocks world, investors just get nervous. They hedge their bets in the bond market, interest rates drop, and we never see any deep financial crisis. But, when the central bank raises this quickly, and you start to see some of these data points roll over as fast as they are, it does seem like there's a monster lurking in the shadows. So let's see what happens next week. So thanks for tuning in. Hopefully you enjoyed this new format. You get to kind of see me riffing live with my thoughts on the week that just passed. There's no script here. I'm just sharing with you as things come to mind, and as I think back on on what went on in the mortgage world, the bond market, the finance world in general, the week prior. So thanks for joining me. Hopefully you'll be here again next week, and I'll talk to you then.